Cash investments. Okay, personal savings allowance, again from April 2016, is introduced for income arising from interest. Okay, so for basic rate taxpayers, they can earn £1,000 worth of interest from any sources. Remember, it could be from their company. If they've got money in their company, get some interest out of it. If they've got money in the bank, you might get some interest out of it. For higher rate taxpayers, they can earn up to £500 in interest and have no further tax to pay. Additional rate payers, you're probably going to get quite a lot of interest, so it's not really coming into play for you. Remember, it's tax-free income. If you can get interest from your company, please do so. From April 2016, banks no longer have to deduct tax from your interest. Probably from April 2016, banks don't actually have to pay any interest, but that's a cynical point. ISAs, well, they changed those yesterday. 16-17 limits remain the same, £15,000, and obviously for the juniors, just over £4,000. But major changes will start from April 2017. The main ISA allowance is going to increase to £20,000. It can be cash, it can be investments, it can be a mixture of whatever you want. The Help to Buy ISA for first-time buyers will continue, although it could be transferred into the new scheme from April 2017. I haven't actually seen many people with Help to Buy ISA, but is this the new pension ISA? It probably is. I remember standing there a couple of years ago saying, pensions ISA, are they going to come together? I think they are now. The Help to Buy ISA was originally established to allow a monthly savings limit of up to £200 a month. Accounts were limited to one per person, not one per household, and they were meant to be available open for 4 years. They're currently available to those over the age of 16 who are going to be purchasing UK properties for the first time. It's obviously not your foreign holiday property, okay? So for every £200 you save, you will get a bonus of £50. Savings were to be a maximum of £12,000 per person, and there was going to be a bonus paid when the house was purchased. Okay, that will be changed from April 2017, as I say, although that ISA will still continue. You can run it concurrent to the new one. Lifetime ISAs. Here we go. I won't ask who's under 40 in the room, but I'm not. I wish I was now. I could have opened a new lifetime ISA. I could have saved up to £4,000 a year, and I could have received a bonus of £1,000 a year from the government for just saving. There would have been no requirement to make a monthly contribution. It could be a one-off contribution, and that bonus will be paid once the individual is 50. Okay? Every individual can have an account. It's not one per household, it's every individual. Not quite sure where they're going to get the £1,000 from for every individual, but there we go. Okay. These accounts can be used to help save towards a deposit for an individual's first home. So they are really trying to look at these people at the bottom end of the scale, the 18 and 20-year-olds. From April 2017, you can have both, Help to Buy ISA and obviously the lifetime one. You could combine if you wish, as I say. But once the individual reaches the age of 60, they can withdraw all the savings tax-free. So they've got to get to the age of 60. Now, pensions, I'm sure they were trying to push the pension back. So ladies, you used to be 60, 65. Gents, we used to be 65, we're probably now about 80. I think it's about 72 at the moment, you never know. Is this a pension? Is this the state pension that you're paying for yourself? Could be. There is caution. We will give you something, but we will take something away. Now, if you're very naughty and you take that money out before you reach the age of 60, it is reported at the moment that you will lose all your government bonuses together with any interest or growth. You can have your money, but you're not going to get the government's money that they were going to give you. Okay? But if you want your money, you're going to have to pay 5% to get it out. Okay? Remember, it's free. Ah, yes, pennies are dropping now, aren't they? Yeah, 5% of the pennies are dropping anyway. So, you reach the age of 60, take it out. You're before 60 and you want to take it out and have a bit of a lump sum, go somewhere, bit of a holiday, worldwide trip. No bonuses and 5% charge to get it out. How are banks and building societies, etc., going to work this? I do not know. They're probably sitting there scratching their heads and they probably don't know either. But someone somewhere is going to make some money. Not saying it's you or me, but someone somewhere will. But let's go on to national insurance. Everyone remember where their card is? No? I haven't got a clue where my card is either. But here we go. Self-employed contributions. Okay, from April 2018, Class 2 contributions. It's a massive £2.30, I think, a week at the moment. Abolished. Don't worry about it. But at that stage, you're only going to be required to pay Class 4 contributions. And from 16-17, that's at a rate of 9% on profits between just over £8,000 and £43,000. If you make profits more than £43,000, you've already paid that 9% bit, you pay an extra 2% on top as well. After 2018, Class 4 contributions will be reformed. Hang on. Class 2 contributions are going to be abolished, Class 4 are going to be reformed. Does that mean Class 4 are going up? Let's leave it there. They probably are. Employer contributions from April 2016. Now we want to encourage job creation. We want to encourage the employment of younger people. We would like employers not to pay national insurance contributions. But that is going to be for all but the highest earning apprentices aged under 25. So those under 25, you employ them, you should not be paying employer contributions for national insurance purposes. Excellent, good stuff. The employment allowance. Okay, current employment allowance in this current tax year is £2,000. You have to claim it as an employer, and obviously the first £2,000 you can get it back if you've already paid it in that tax year and you haven't ticked the box correctly. See our payroll department, they will be able to help you. That allowance will be increased to £3,000 from April 2016. Good news. So we're going to give you something. If you've got a group of companies, just take a little bit of care. It's one allowance per group of companies. Okay? It's not available to domestic employers, including gardeners, nannies and cleaners. Okay. Let's get down to the crux of it. Okay. Single person companies. Okay. You're not going to get it, but you have to disclaim it in your first payroll submission in the next tax year. And if you don't, oops, you got a wrong return. I bet you're going to be fined. So make sure if we don't do your payroll and you do your own, just ask us a few questions. Or we could actually do your payroll in the future. You just never know. So for those companies that only employ one person and they're paid more than the lower earnings limit is a single director. Let's have a look at this. So if that single director company had an employee who was paid above that limit, then the allowance would be available. Remember wife's wages back in the day? There's a few smiles. I bet there would be a few more wife's wages. Remember, if you are going to have wife's wages, please make sure you pay it. It has to come out of the company bank account into the individual's bank account. But single person companies do not get the allowance, okay? Wife's wages, hang on a second. I said you can do it. Oh no, you can't. So if you take any action for which is the purpose to obtain the employment allowance, you're not going to get it. So don't be silly. There will be penalties and there will be action taken. You will have more than a slap on the wrists, okay? For those 21 and under, from 6th of April 2015, so we're going back in time, employers have not been required to pay Class 1 national insurance of earnings up to £43,000. If I was under 21 and earning £43,000, I'd be happy. Over that amount, the employers are liable to in the normal manner. Employees will still have to pay their own contributions. Now, when was the last time you saw someone under the age of 21 earning £43,000? There we go. From April 2018, employers will be required to pay national insurance on payoffs, so the bye-bye, there you go, thank you very much, over £30,000 where income tax is also due. Okay, so it's for those employees who have lost their job. Payments up to £30,000 will remain tax-free and they will not need to pay national insurance. Something for the future. Okay. Recently suggested by the Office of Tax Simplification. There is an office, a specialist office for this. They've been suggesting that they're going to review the integration of the tax and national insurance system. This has been a long time coming. Because one reason, if I have more than one job and if each job allows me to be paid less than £672 a month, I personally do not pay national insurance. If I have one job and I'm paid more than £672 a month, I pay national insurance. So I can have two jobs paying me in total £1,000, I don't pay national insurance. I can have one job paying me £675, I pay national insurance. It's not fair. They will stop it. Okay, inheritance tax issues, here we go. Headlines are very misleading. The nil rate ban will remain at £325,000. I know everybody in this room has heard of what about the additional bit? But since 2009, £325,000 has been it, and they're not going to change that until at least 2021. Any unused relief can go to the spouse. So whoever dies first, generally assets go to the other half. I'm not saying which half, but they go to the other half, and they can have, on their second death, £650,000. The additional nil rate bans, everybody went, whoa, that's good. But remember, it's on second death, really. Okay. It starts at £100,000 from the 6th of April 2017, increases by £25,000 each year. The headline rate is £175,000, but that only comes in 2021. You have to claim it, it is not automatic, and that is done on IHT forms. But that only applies to a qualifying residence. Okay? So that's one that has been the residence of the deceased person, and that they have passed it on to direct descendants. Now, they've confirmed exactly what direct descendants are, so it could be stepchildren, foster children, and seems like any other way from stray in the whole world, by the sounds of it. The catch, okay, the nil rate ban will be available when a person downsizes or they cease to own the home. Perhaps they've put that money into other assets, and the value as of a certain date, the 8th of July 2015, is the one that determines it. So please go rushing out there and get your property valued at the 8th of July 2015. It could be worthwhile to you. So direct descendants, unnatural children, stepchildren, adopted children, foster children. For married couples, there could be a huge IHT saving. Again, all these details are in your notes, so I'll quickly go on, so I can see time's going by. Remember to get it, the most important thing is you have to die. It is not a lifetime allowance. I'm sorry, but you do have to go. Okay, apologies for this. If your net estate exceeds £2 million, the value of that relief will be reduced. Net estate, I will go on to talk about what that is. The net estate, that is the value of your estate less liabilities, not beneficial tax reliefs. Now, we all know in this room, we've probably heard about business property relief or agricultural property relief. Well, their name's been changed. The property never comes into it anymore. But they are not used in this calculation. It's the value of your estate, less liabilities, not relief. Okay? So you might get the 175,000, but you might not. So I will give you something and I will take something away. Planning faults. It's only available on death. Bit of a problem, okay? Will it discourage the more mature generation, I won't say older, but more mature generation from disposing their own home? Will they continue to live in that high value property? I know and I understand it's very difficult to undertake some really, really useful IHT planning because of the fact you have to give up the right to enjoyment of an asset or income, and you work very, very hard for it all your life. It's difficult, I understand that. And if you do give up your main residence, which is invariably where the cash is at the moment, there are guests with reservation issues. You might have to pay the next person rent to live in your house. That never goes well.